Hello again, this is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is May 21st, 2020, and there's some topics I want to discuss today as I was going through our daily market observations, what traders are watching, all the 50 plus publications in the morning as we get up early to sort of source what's important and what's relative as we prepare our clients' portfolios and the trading day ahead. And we're going to discuss that. Obviously, USChina Rhetoric worsens, and that's going to continue worsen. I'll talk about that today. We're also going to discuss the S&P 500, as I've discussed in several times of my daily updates, and provide sort of a trading range that we see playing out right now for the S&P, as we said several times before. But today's biggest headline just came out a little while ago, and I think we're going to see it play out all over the newspapers, especially the business section, the front full tomorrow. So we're going to have today's newly reported information on home sales. We're going to discuss that. We're going to discuss the headlines, how negative the headlines are because it's a bad number. But really go into ultimately what we should be prepared to pay attention to versus what the headline actually says. So let's get right into it. Let's discuss the real estate market itself as it was just reported by the National Association of Realtors and updates that we receive in the month of April. So let's go into it. The headline read, home prices dropped nearly 18%. Actually, yeah, they did drop, and it was a negative number, and it's not unexpected. I mean, we expected a lot of negative economic data that are coming out because the entire United States is on a shutdown. So sales dropped 17.8%. So, but if you're in the news, might as well just round up to nearly 18% because it'll get somebody to read the story. So I encourage you to read all of the story tomorrow, okay? Because the underlying economic information within is actually pretty impressive. I was shocked by this personally. So let's go through this. Prices, 7.4% year over year. You would imagine that would be down, right? The stock market's down. Everything else is, sort of, we're all concerned about the world that we're living in. We can't leave our homes. There's no way houses could be up. House prices jumped 7.4% year over year. There's several factors to this, but it's important to read beyond the headline and actually look at the data that's coming out there. And I'll discuss why. There's a few factors. Number one is, the supply is now decreased. We're actually at a 4.1% monthly supply. And the reason why is you couldn't list your house in the last 2 months, 60 days, if you will. It was hard to, especially in some cases that had completely state shutdowns. There are other places where the states weren't shut down as much, if at all. But the supply is down. So when supply is down, prices go up because the demand is still there. Median home prices, sort of tip my hat on this one. Interestingly enough, that we're at all-time average home prices in America. That couldn't happen, right? I mean, we just went through a pretty tough economic time right now. Mortgage applications, that's got to be down. I mean, down substantially. That's got to be, it's only down 1.1%, less than 2% year over year. That's pretty impressive. The fact that we can only be down only 2% of mortgage applications year over year, when last year we had a bustling economy, and right now you can't leave your house to get a mortgage done, that speaks to technology. See, what's happening right now is we're in a technological revolution, and technology is pulling us through this, right? We're working from home. Economies are still happening. Markets are still transacting. But the glue right now, this revolution is taking place right before our eyes. People learning to use video like they never have been able to do before. People have learned to work and be more efficient from home like they've never been able to do before. So the economy is actually proving out to be more resilient than what markets, equity markets, were pricing in. Even worst case scenarios at some point in time, even a few months back. Now, it's not to say that we're not going to have a slow moving economy going forward because of all the economic damage that's being created even as we speak. And that's tragic. So one final comment on the real estate market is this. What also is in the report that wasn't in the headline, which to me was absolutely incredible, like startling. I couldn't believe it. They said that the last 6 weeks, okay, of those homes that went under contract, meaning people put those homes in escrow in anticipation to purchase, 41% of those in the last 6 weeks had bidding wars on those properties. Yes, let me repeat that. Over just about nearly half of the homes over the last 6 weeks had a bidding war. So we know there's short supply. We know interest rates are at an all-time low. We also know that you can't leave your house, but you have technology right now. My wife's a real estate agent, and she's been busier than ever, using new technology that helping clients, in terms of doing virtual tours. So it is happening. There's parts of the economy that do have life, even more than what the headlines report. I'm not to say again that it's not a slow road ahead, but I would tell you that there's some real optimism out there to show how resilient our U.S. economy is in different sectors of them. So this is residential real estate update for you. You're going to see the headlines all day tomorrow, and I just encourage you to look beyond the nearly 18% down in sales in the month of April that you're going to read, and sort of read the information for yourself and make your own determination. Our second topic of the day is, and I'll be brief on this one, S&P 500 trading range. Now, I've reported based upon our research and technical and fundamental research that we do on a daily basis for our clients here at Blanke, Schein Wealth Management, we do believe that we're in a trading range, and I provided sort of the range bandwidth that we could see S&P play out over the weeks and months to come, and that was several weeks back. So if you wanted to go back on a daily update that I provided, we've still maintained, we're still being in that range, if you will, and the information that we've been working on has been pretty accurate. That we're bumping up against, and we have been several times, on the 2,900, just under 3,000 for the S&P 500 range, if you will, and that's key and critical. The fact that we're right underneath it, and we have been for quite a bit of trading sessions right now, is very constructive. It really shows that we're consolidating. The market is showing signs of broadening out, meaning other sectors are now seeing some market rotation. That's all positive. And whether we break through on the 2,900 to 3,000 side on the upside, 29.95, I believe, is a pretty big ceiling right now for the S&P. If we break to the upside, that could be at any point in time, overnight. We get a key medical breakthrough that is game-changing, that no one really saw coming or no one predicted it could happen. I think that's where the S&P 500 right now is sort of hanging out in that trading range. But in the meantime, there's a lot of opportunity. We like to see that the volatility has now lessened a little bit. We still see some volatility on a daily and weekly basis, and that's going to just continue to provide more opportunity. But S&P 500, keep an eye on it, as we are. So let's discuss our final topic of the day. USChina Rhetoric worsens. The last 48 hours of the news cycle, even today, China has upped the ante as it relates to negative threats, what they could do, pulling some of their, delisting some of their companies from the NASDAQ, as the U.S. has already thrown down a myriad of threats and tariffs and everything else. Now, let's take you back in time. Both these, countries, even, pre the pandemic, both had a 12 to 18 month love-hate relationship that played out very publicly. One day it was on again, the next day it was off again. One day we're writing love letters, the next day they're writing love letters. Next day they're getting, they're not going to prom together, if you will. I don't even know. Ultimately, the actions speak louder than words. I think that's key and critical, because both sides, while they agreed to disagree, they both made a deal. So we see that playing out in the long future, but in the near term, we want to be concerned as it relates to what could happen. So we're monitoring this relationship very closely. We want to make certain that it stays in the rhetoric camp, and that both sides don't ever leave sort of the trading talk realm, where they're both going to take their ball and go home, if you will, and not come back to make whatever deal or negotiation on a go-forward basis needs to happen. But this is a story that's going to continue to evolve. It's very important as it relates to our clients' investments, so we monitor it on a daily and weekly basis. So I'm going to report more on it, but that's the update. I mean, I think the rhetoric will worsen before it gets better, but it's a love-hate relationship. I don't think each party at this moment in time could live without each other. So let's just keep it in the, hopefully they continue positive talks and continue just making forward progress in a positive way. I wouldn't hold your breath on that one, but so that's why we're going to keep watching that one. So thanks again for watching, and have a great day.